Everybody, what's up? We are back once again with a new video. Today we are looking at Chegg. So Chegg is basically a education resources company. They do a lot of like homework help, studying, kind of things like that. But their stock price has seen one of the biggest downfalls I have ever seen in my life. I think they're down 96 or 97% from their all-time high, which is absolutely insane. So we are going to look into their earnings, look into their financials, look into their stock chart, and basically try to figure out what's going on there, get some more information on the company. And that's about it. So make sure to subscribe, comment any companies you want me to review, and I will get to them as soon as I can. And let's get into Chegg. All right, so looking into Chegg, I honestly don't know what to expect here, only because their stock has dropped so much that I really just have no clue like what is going to be going on. But overall for the snapshot, I mean, looks okay. Cost capital is low. Target price is actually at 186, which is significantly lower than the 245 it's at now. So that's a little concerning. Long-term growth rate at 30% though, which is very good. Let's go into the income statement. Maybe we can get some answers. I don't even know what to expect with this company. So sales looks like peaked in 2021, bit of a decline since then. I'm assuming that's what's going to be going on here. They clearly very drastically lost their net income, so that is not great. Sales not great. Operating income looks like they're supposed to be positive this year, which is hopefully good. I'd imagine they cut a lot of costs, but you could even see like their operating income was never anything crazy either. 662 million in sales compared to 8 million in operating income is terrible. So overall, even though it is going positive, I can't give the full credit there. I mean, it could even be negative this year. We don't know because the full numbers aren't in yet. And then net income, massive, enormous loss. Looks like it's mostly just from unusual expenses, which can't even tell you what that is, unfortunately, but not looking good. EPS, again, just overall going down. Total shares, actually, I guess they have been buying back shares since 2021, which is a little strange considering how much their sales have been suffering. I can't believe they're repurchasing shares instead of investing in growth, but a win is a win, I guess, for the company. But it looks like they are going to start trending back up this year, possibly. Let's check out the balance sheet for Chegg. Maybe we could see some more positives here. So, okay, cash took a bit of a hit recently. Short-term debt, they just brought on a ton. They had very little, just brought on 357 million, which is not great considering they also spent basically 70% of their cash in the past year. So overall, that could be bad. We're actually going to go into the quarters here only because there is no results for 2024 yet estimated for their balance sheet. So overall, total assets declining over the past few quarters, and it looks like they have been in decline for at least the past 2 years. Again, with cash, does not look great compared to their short term. And although long term has been basically minimized, their short term has basically picked it back up. So overall, cash is okay. Assets again decreasing fairly significantly. Short term debt is not great. Overall debt, I'm going to give the 0.54 because their long term is being minimized fairly significantly. I know it stayed flat for the past 4 quarters, but it has come down a lot from where it was, which in my opinion is pretty good. And then retained earnings is probably not going to be great here, I'd imagine. And no, it is not. Big fat negatives. So not great there. Now let's check out their cash flows. Maybe we could see some kind of improvement, possibly. Operating cash flow is positive. Their funds from operations, though, is not. It's very, very little. Most of it is from other funds. That's basically the only reason it's positive, that it looks like. So I don't even know what to say about that, but it's getting the 0.5 because their funds from operations is very little, which is not good. CapEx is the majority of investment activities, and then obviously they have been purchasing investments over the past 3 quarters after a lot of selling about a year ago. So that is good that they are repurchasing investments again. I'm still going to do the 0.5 here because it's just so mixed. I know I want it to be negative, but overall, with it just being CapEx and just happening in the last 3 quarters with purchasing investments, I can't really warrant giving it the full credit there. And then for financing, it looks like not much has changed. Obviously, it looks like they reduced some debt about a year ago, issued, or I should say, repurchased some stock about a year ago. This year, they haven't really done anything. So overall, I'm just going to stick with the 0.5. It might just be a 0.5 across the board. Their free cash flow has gone positive, which is good. I don't know if it was negative recently, but it is also declining. You can see it was negative last quarter, back up this quarter, but overall just declining from where it was 2 years ago. So 0.5s across the board for the cash flow. Now you might be asking why I didn't give zeros. The reasons I didn't give any zeros are because I want both of these to be negative for the most part. If they're getting their cash from investing or financing activities, that's usually not great. Now, the way they're doing it also isn't that great because you could tell like they did start purchasing investments, but only recently. That's why I gave them the 0.5. And they haven't really done anything in financing activities. So that's why I gave them the 0.5. They were buying back stock and they were reducing debt here, but it hasn't been for 4 quarters or 3 quarters. So that's why the 0.5s are there. So anyway, let's get into the use of cash. Hopefully we can see some better things. And it looks like you can see here over the past 2 years, no debt issuance and a lot of debt repayment, which is good. That is what we want to see. And then for stock repurchases, you could see 3 big ones here, very little issuance, which again is good. All in all, use of cash is solid. So let's get into the ratios. I'd imagine these are going to be terrible just based on what I've seen so far. But maybe we can see some surprises, but honestly, it's not going to happen. So SGA to sales is way above the 5-year average at 75. Not great. Net margin is looking like terrible, although last year in 2022, their net margin was 34%. One thing with this company, which is absolutely baffling, is that this is a company that just runs a website that has a subscription-based model. The fact that their net margin is 2.54% is absolutely terrible. This is a website online. Their only costs should really be advertising, administration, and like any website costs that they have. Net margin, you can see, went negative over the past 2 quarters after dropping very significantly. I don't even know what to say for this. That is absolutely terrible. ROA and ROE, same exact story, just massively negative. Long-term debt to total equity just shot up over the past quarter, actually. So they either lost a lot of equity, which wouldn't be surprising, or they gained a lot of debt, which also would not be surprising. But overall, it used to be really good. There was 2 quarters where it was under 30, which is very, very solid. Not really great anywhere else, but overall, it has been increasing for 2 straight quarters, and it is now very significantly high at 144%. So overall for Chegg, 32%, honestly, kind of unexpected. I really thought that they were going to have solid financials and just have some kind of problems with some news or something, but overall, kind of terrible. Let's get into their recent earnings report. Maybe we could get some answers as to what this company has been doing wrong. But who knows, honestly. It could be a lot of things, but so here's their recent earnings report. You can see not really much to go on here. Subscription services beat. Skills and other looks like came in just under barely. Gross margin beat. EBITDA beat. And subscribers fell a lot by 13.6%. So this is the big one. Although their revenue clearly beat, their subscribers beating means long-term revenue growth is going to be very, very difficult. Now, if you're a student, like me in college, you get ads for Chegg fairly frequently. I see them a lot, and I'm assuming what's going on here is this company is spending way too much on advertising that isn't effective. I have actually used Chegg in the past, but I would never keep a subscription for more than maybe 2 or 3 months, and then I would cancel it once I was done. So I'm assuming what's going on is they just have a very hard time holding on to subscribers. But overall, not great there. Um, Looks like there may be some kind of Outlook things here. Obviously, there's a giant wall of text here, so not going to read all of this, but some things I just want to see. Headcount reduction by 21%. That's probably good with helping with their expenses. Buy back convertible stock and common stock. That could be interesting. So overall, there is some things in here. Oh, here's one thing that could be really important. We do not expect to meet our 2025 goals of 30% EBITDA margin and 100 million in free cash flow. That is terrible. It looks like this came out November 12th, and basically they just announced further restructuring of their company. So overall, that is probably really bad. I'm sure investors liked that a little bit only because it kind of reaffirmed future profitability, possible future profitability, but again, could be very, very bad for the future of the company. So you could see big drop after earnings day, but it has come right back up since then. This company has a long, long way to go to get to where they were. This is the daily chart, and they are nowhere close to the over, looks like just that 115 per share price they were at. They have really, really been suffering, which is actually a little shocking. I mean, you would think with all of the subscribers gained from COVID, they would kind of see sustained growth after that, but I guess not. But overall, bit of a short-term rebound. I mean, they were at 138 at one point, 134, and now they're at 245. So if you played the short term, congratulations, you're probably up a decent amount. But overall, I don't think this company is going to be back to where it was for many, many years, if ever. And it's probably in a pretty prime position to get bought out at some point. They're either going to get bought out or they won't be able to meet their free cash flow goals and will run out of cash or just spiral downwards into debt. But either way, that's just my opinion. Do your own research on the company. No investment recommendations here. But that's it for Chegg. Make sure to subscribe if you enjoyed. Comment what companies you want me to review. And that's all I have for today. So I will see you in the next video.